So we've all heard about investing in Bitcoin, right? But what if I told you there might be a way to get amplified returns? A way to actually outperform Bitcoin itself by investing in something completely different? Well, in this explainer, we're going to break down a really bold thesis that claims you can do just that.
Okay, so the source material for this whole thing kicks off with this pretty audacious statement. I mean, there's no pulling punches there. This really sets the stage for a high-conviction, super high-stakes strategy that isn't just about trying to match Bitcoin's returns, but trying to absolutely blow them out of the water.
And that, right there, brings us to the central puzzle. It just sounds wrong, doesn't it? How could buying a stock in some company possibly give you a better return than just, buying the asset itself? That's the core question we are going to unpack.
To really get this, we first need to break down the fundamental idea here. This isn't about just buying stock in a company that, happens to own a little bit of Bitcoin. No, this is a very specific kind of company with a very, very singular focus.
And here it is. This is the key definition you need to lock in: a Bitcoin Treasury company. It's not just a company that dabbles in crypto. Its entire reason for being, its only real business really, is to acquire and hold Bitcoin on its balance sheet. That's it.
So here's the magic trick, at least according to the source. These companies can do something that you or I can't really do. They can go out and raise huge piles of cash by selling stock or issuing debt, and then they pour all of that money into Bitcoin. What that does is, it effectively gives their shareholders a leveraged or amplified position on Bitcoin.
Okay, so how does this actually work in the real world? Let's take a look at the first case study from the source, MicroStrategy. This is the big one, the most famous example, and it represents what the source calls the scale play. Basically, a strategy built on being the biggest player in the game.
You might be wondering, how does a company this huge just keep buying more and more and more Bitcoin? Well, the source describes it less as a bunch of simple purchases and more like a self-reinforcing cycle.
And this slide lays out that cycle perfectly. The source calls it the flywheel. It starts right here. The company raises capital. They use that cash to buy Bitcoin. Then, if Bitcoin's price goes up, the value of their assets shoots up, which in turn boosts their stock price. And here's the kicker. That higher stock price makes it cheaper and easier for them to raise even more capital, to buy more Bitcoin. And the wheel just keeps on spinning.
Now, this strategy, as you can imagine, has a lot of critics. But the source material is, well, completely dismissive of them. This quote right here just shows you the level of conviction behind this whole thesis. It basically frames any criticism as just noise from uninformed bears. Okay, so a really common criticism is this. How can the company pay the interest on all the money it's borrowing if its main asset, Bitcoin, doesn't generate any cash flow? Well, the source has a counter for that, and it's this number. They calculate that MicroStrategy holds enough Bitcoin to cover its debt obligations for nearly 76 years.
But the scale play isn't the only game in town. Let's look at a second case study, a company called Metaplanet. And this one introduces a completely different, really fascinating variable into the equation: currency dynamics.
The argument here is that a company's home country matters. A lot. Specifically, being based in Japan gives Metaplanet what the source calls a structural advantage that US-based companies just can't get.
And this slide, wow, it shows you the raw data behind that advantage. I mean, just look at this. Bitcoin's growth in US dollars has been absolutely insane, obviously. But its growth, when you measure it in Japanese yen, it is on a completely different level. That huge gap between the two bars is the entire key.
And to put a really fine point on it, over the period they measured, Bitcoin performed 1.43 times better in yen than it did in dollars. That might not sound like a crazy number, but when you're talking about these kinds of returns, that difference compounds into something absolutely massive over time.
The source even gives us a pretty cool name, the FX Turbo Boost. The logic is actually pretty simple. As the yen gets weaker against the dollar, each Bitcoin, which is priced globally mostly in dollars, becomes worth more and more yen. It's like a constant tailwind that US companies just don't have.
Okay, so we've got the scale play and we've got the currency play. Now, as you can probably imagine, the source projects some absolutely wild long-term numbers based on these ideas. But now let's peek under the hood at what some might call the moon math and see what assumptions are really driving these forecasts.
So here's the most important thing to remember. These huge projections, they aren't prophecies. They're just the outputs of a financial model. If you change the inputs, the results change completely. So everything, and I mean everything, hinges on whether a very specific set of assumptions holds true.
And here are the big ones. The models basically assume a high and steady growth rate for Bitcoin, like forever. They assume that the companies can keep adding more Bitcoin per share at a fixed rate every single year. And they assume that the markets will always be happy to give them more capital. These are some pretty big ifs. And here's where it all comes together. When the source plugs those assumptions into his model, the result is pretty fascinating. He projects that Metaplanet, with its currency advantage, has a much higher potential return, a 72.5 times multiple over 15 years, compared to just under 50 times for its US counterpart.
But, to be fair, the source himself admits that this kind of long-range forecasting has its limits. He even says that assuming a company can keep growing its Bitcoin stack by 75% a year is unrealistic in the long run, and he highlights that these kinds of static models are really better for just looking at the near term.
So, after looking at the mechanics, the case studies, and the math, what's the big takeaway here? Let's try to bring it all together and figure out what this strategy really represents.
And I think this slide perfectly illustrates the two sides of this high-leverage coin. The bull case, as the source lays it out, is pretty clear. You get amplified gains through leverage and maybe some unique currency advantages. But the implied risks are just as big. The models are super sensitive, losses also get amplified on the way down, and the whole thing depends on management executing perfectly.
When you boil it all down, it comes down to this. Investing in these companies isn't just a bet on Bitcoin, it's really a dual bet. First, you have to be right about the future price of Bitcoin. And second, you have to be right that these specific management teams can keep executing their unique strategy flawlessly for years and years to come.
Which leaves us with the final big question. Are we looking at a sophisticated new model for how companies manage their money? A way for public markets to get supercharged exposure to a new asset? Or is this whole thing just a highly leveraged, super high-risk bet that really relies on a perfect storm of positive conditions to pay off? That's really the core tension at the heart of this amplified Bitcoin thesis.